I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Good morning, everyone. I'm T3 Live Editor-in-Chief John Darsie.
And I'm Brittany Umar, and together we bring you Morning Call. So world markets are flat this morning. Our futures are pointing to a higher open ahead of day 1 of the Fed's 2-day meeting. Of course, we've been seeing a lot of indecision and indecisive behavior ahead of the start of this meeting. So how do we brace for today in light of this?
Yeah, I mean, there's been some volatility in the market, but we've sort of been spinning our tires. We haven't really been going anywhere, and that's a natural thing to see ahead of a big, potentially market-moving announcement like the Fed rate decision. Especially the Fed has become more and more in the spotlight, and everyone hanging on their every word as that idea of QE tapering has proliferated a little bit. So we've seen the market bounce around in a range for an upper level wedge pattern, but we haven't been going anywhere, and I don't think that'll change today as we wait for tomorrow afternoon's announcement.
Right, and just an example of the sort of indecisive behavior we've been seeing. Markets had been strong yesterday until that Financial Times article signaled that the Fed tapering would be imminent. They would say that it would be imminent on Wednesday when they released the minutes from the meeting. What do you think we should do heading into that today?
Yeah, the Financial Times article was interesting because the market was roaring ahead of that. It was a little bit surprising that the market was so strong prior to the Fed announcement, but then that Financial Times article came out saying that the Fed is going to hint more at QE tapering potentially in September, things like that. It triggered a sharp sell-off in the afternoon that erased most of the market's gains for the day. We were able to bounce into the close, but it was really interesting to me because the article pretty much matched the expectations that are currently in the market right now. Everyone sort of expects them to inch more towards QE. They're sort of massaging the expectations down for people that want the punch bowl to be there indefinitely, but there was sort of a trial to see how the market reacted to talk of QE tapering, and the sell-off really hasn't been that extreme. It was a 5% correction down to the 50-day moving average. It's been a double bottom, but it was interesting that we had that sell-off, and I think we'll continue to get rangy type action leading into tomorrow's announcement.
So I can give us a visual and show us the levels that we should be watching in the S&P right now. Yeah,
I'll give you a look at that wedge pattern we've been talking about. And we have our trend lines drawn here. From that May 22nd outside day has continued to control the market since it happened. We talk about the most recent loud technical signal is the one that you really pay the most attention to, but yesterday we almost had another loud technical signal that might have broken that downtrend a little bit, as you can see that doji candle from yesterday. And right now basically we have a doji candlestick yesterday, which is a candlestick of indecision, and you have a wedge pattern, which is the pattern of indecision. So as you can guess, the theme of this market right now is indecision ahead of the Fed. It's going to be a market-moving announcement, and neither bulls nor bears are really willing to make big bets in either direction. I think if you do get a push higher today, it'll be because of short covering, and if we were to get a break below, which would be a big move today, but if we did get a break below, it'd be longs capitulating. I don't think there's any new money making bets in this market as a result of that announcement tomorrow.
Well, tech stocks saw some nice action yesterday, showing healthy relative strength. Why do you think the interest in tech at this point?
When you have rising interest rates, everyone's chasing yield because in a low interest rate environment, people are piling into dividend stocks, value stocks that can generate you a nice 3-4% yield, and you can also potentially get price appreciation. And you saw a lot of that. Consumer staples, utilities, those are all the sectors and stocks that have led the market for most of 2013. That was a big theme in the first quarter into the second quarter. But recently, once the start of QE tapering started, you saw a sharp sell-off in sectors like those consumer staples and utilities. That's been evidence of the fact that people are piling out of those more defensive assets and getting into perhaps riskier equity assets, and those riskier equity assets are tech stocks. And as a result of that, you're seeing a reflection on the charts that people are more inclined to be buying tech stocks right now. We have some really nice setups in tech that dominate. Last night in our Off the Charts newsletter, we talked about the most bullish setups out there, and it was highly concentrated in tech.
Right, so you compound that with great news like we got for Netflix and its DreamWorks deal, and that can really help to lift the stock as it did with Netflix.
Yeah, I mean, Netflix, that was a little bit of an isolated case because of the news, but really nice action in Netflix. If we go to the chart, You see that big gap up. You had the content deal with DreamWorks that basically they're going to collaborate to produce original content based on DreamWorks movies like Shrek and things like that. They're going to produce series to try to get back into that kids demographic that they lost when they decided not to renew their deal with Viacom. But very big news for Netflix, and the stock responded in kind with the gap up, and it held that gap up, was strong all day. And if we could build a new upper level base, we could get another leg higher, I think, in this highly shorted stock. And we've been stalking this downtrend for a potential entry intraday, and that gap took that opportunity away from traders, which is always a little bit frustrating. But if we do get another base, a stock with a high short float, I think can really squeeze and potentially get back to highs.
And then you take tech stocks like Cisco and Hewlett-Packard, which both gapped up on earnings reports and are still holding higher.
Yeah, I mean, one of our favorite setups that we talk about in our swing trader course, our active trader course, one of our bedrock philosophies here at T3 Live is that we love stocks that gap up on earnings and then form another base above that gap. That's one of our A-plus setups, and that's what we've seen with Cisco and Hewlett-Packard. If you take a look at the chart of Cisco, you can see that gap up. It was strong off the gap. It tried to fill back a little bit, but was contained by the 8-day moving average, which is very healthy action. You can talk about Fibonacci retracements of the gap. It didn't really touch any of those. And then you have a nice upper level base. And yesterday, it was a situation where Cisco wanted to break out, but that broad market sell-off during the early afternoon really prevented it from happening. So we saw a similar thing a couple weeks ago with Intel that I talked about. Intel wanted to break out, but it was a day that we had a lot of broad market weakness, and it was just held down by that. And then once that weight was lifted from Intel, it was able to bounce. And that's a similar situation I think you'll see with Cisco. We can even zoom out to a more long-term chart. If we go back to the chart of Cisco, we'll even go to a monthly. Get a good look at it. It's coming up into some more major resistance around the $28 level is the next area that could really contain Cisco. So I think you could see more upside in that stock. Hewlett-Packard, as you mentioned, we'll go to that chart. It's a very similar situation to Cisco, perhaps not quite as strong, but it had a smaller gap up, but it was even stronger on the day after the gap, and formed a tight upper level base that you can really measure your risk. You can put your stops at the lower end of this range if you're looking to make that trade. And then on a break of this pivot up here, you can possibly get involved to the long side as the 8-day and 21-day moving average are pushing this stock higher. I'll also zoom out to a longer-term chart of HPQ. Doesn't really have much of anything in terms of resistance until that $30 area, so definitely two stocks to keep an eye on.
And even SanDisk showed impressive relative strength yesterday. Looks poised to make a move higher. Where would you say resistance is here? Yeah,
SanDisk, another one that was extremely strong. The pattern is not quite as calculated as the ones in Hewlett-Packard and Cisco, but I think on any type of base or any type of dip in the market, SanDisk is one that you could potentially be looking to buy. If we go ahead and take a look at the chart of that one too, see a nice move yesterday out of that base. It was, I talked about Hewlett-Packard and Cisco sort of being weighed down by the broad market sell-off early afternoon yesterday. SanDisk was undaunted by that. It just continued higher. Very small tail, but it closed above its pivots right there. We're going to zoom out again on this chart, and you can see it broke above some long-term resistance from the last few years here. And then the next real resistance level is a little bit above this. You can see this tail back from 2006. That's the levels we're talking about in this market right now because things have been so strong. But beyond that, if we can break above that, you're talking about the $70 area potentially for SanDisk because it's had a major resurgence, not only from 2008 around below the $10 area, but even more recently in 2012 off the $30 area, it's doubled. So just an example of some of the really strong moves we've seen in the market over the last couple of years.
And if we're talking tech, we can't leave out Google and Amazon standouts in this sector that continue to look good. Are these both cases where you would buy on dips?
Yeah, Google and Amazon are ones that they don't really have any pattern that's hugely actionable right now, but I just, based on the behavior we've seen of those stocks since the most recent earnings report, because sometimes things sort of reset every earnings season, but those have been extremely strong. They've been market leaders, they've been tech leaders, and especially Google is one that I would, over my lifetime, I'd be comfortable buying on any dip because they are innovating. They have their core search business, which makes them, a compelling value investment, but they also have the Google X Labs that they do all these sort of far out revolutionary type projects. One example being Google Glass, which could evolve and revolutionize technology in general. You have self-driving cars that they go after. Project Loon is a recent thing they've been doing with basically hot air balloons that float around and create a Wi-Fi network. and brings Wi-Fi to places that have never really had it before. Talking about remote pockets of places like New Zealand, which was the test project for Project Loon, and Africa is one that could be really revolutionized by getting more wireless internet because of this. But basically what I'm trying to say as I'm babbling about my love for Google is that all these projects are making Google even a more compelling growth story beyond just their core search business and Google Wallet and all that type of stuff they have. They have a lot of things, a lot of irons in the fire, and it could really make it a compelling investment long term that you could buy on any dip. So I'll take a look at the chart of Goog. We've had a nice pull off the 920 area that it did spend some time below the 8 and 21-day moving averages, but it's now back above and looking healthy, and I think it's just a matter of time before it sees all-time highs again, and I think it's just a matter of time before it sees the $1,000 area and beyond. And
Amazon also just more room to the upside?
Yeah, Amazon is one that I'm not as in love with Amazon because, frankly, the company doesn't make money yet, but they seem to get a pass from Wall Street every earnings season. They come out with a report that sounds really bad, and this time we got a sharp sell-off on their earnings report, but it found support of the 200-day moving average again, and there's always demand for Amazon seemingly on any dip because they do spend a lot on the future and they do a lot of investment, so that people are betting that's going to pay off here eventually. And we have sort of a nice little cup and handle type situation, not exactly, but you see a nice little handle that is formed in Amazon that could pave the way for higher prices. We talked a lot about the descending channel that had formed at the upper level of the chart of Amazon. It was able to break above that a couple weeks ago, a very impressive move. It was a little bit discouraging to see it retest back down into that trend line, but the fact that it's bounced off that trend line is very positive. I think could lead to a nice entry price for Amazon for another breakout.
All right, coming up, we're going to talk home builders after yesterday's positive housing data, but first a quick commercial break. We'll be right back.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
We're back and talking home builders after yesterday's positive housing data. A report yesterday showed that June's housing market index jumped to 52, and that's the first time in over 7 years that it reached over 50. So we saw the XHB rise 1.5% on the news. Do you think we'll see the home builders now lead us higher?
I mean, that was a huge housing number yesterday that put a jolt in the market, and more specifically in the home builder sector. That's been one of the sectors that's been extremely weak and leading the market lower as a potential one of those red flags that this market is due for a bigger correction. But over the last 3 days, yesterday's news provided a nice follow-through, but even over the last 3 days, we've seen a nice bounce in the XHB. We can go ahead and take a look at the chart. Things were looking broken for the home builders, and people were talking about a long-term top, as we could see housing not tick up as fast as many people had hoped. We saw the XHB go below its 8, 21-day, and 50-day moving averages. Didn't really look like there was much that was going to catch it, but saw a nice reversal here on this day. It came back up into the 8-day moving average, found some resistance there, but then late last week, big igniting bar to get back above the 8 and 21-day moving average. On Friday, it was really healthy to see it just digest those gains and still hold above those moving averages. And then yesterday, obviously that big housing number triggered a nice move in XHB. If we can continue to see XHB rally, could be a huge boost for the market. One of those weights that's been weighing it down a little bit could be lifted. It could be a very positive thing and could lead us to a positive breakout of this more macro wedge pattern that we're seeing in the S&P right now.
All right, and we're going to bounce around and do some quick hits here. Let's talk Visa, which is consolidating at upper levels, digesting recent gains. Do you think it's gearing up for higher prices?
I feel like every 2 months on the morning call, we start talking about Visa again because it's basically trend higher, make a base, and then trend higher again. We could be seeing a similar type of behavior in Visa right now, a similar type of setup. We'll go ahead and take a look at the chart. You can see I'll zoom out just to give you some perspective on that. I mean, look at that chart of Visa, rock solid company that you could have back in 2010 bought it, around the $70 area, and you've seen obviously more than a double as it's been in just a steep uptrend, no real challenges to that uptrend. We'll go back to the daily chart though, we see another nice upper level base in Visa. It's above its 8 and 21 day moving averages. It's sort of flagging after this move into the base. So what you do is you measure the potential move, the inbound move, to forecast the outbound move. So you see a move from 170 up into the $180 area. So if we do get a breakout of 185, could see Visa up into the 195 area. But these credit card companies, regulation and stuff has been very friendly to them. They could continue to see more upside. MasterCard we often loop in the same category, but I think Visa has the better setup right now.
And our guy Elon Musk still providing traders with opportunities in Tesla and SolarCity. Tesla recently breaking above 100. It did break above key resistance yesterday of 102.90. So tell us what's the trade here in Tesla at this point?
Yeah, Elon Musk, we were talking before the show, just such an impressive guy. I know we've talked about it several times here on the morning call, and his stocks continue to hold up pretty well. We'll talk about Tesla first. Tesla, obviously the electric car company. I think the next earnings report for Tesla is going to be very, very important and very interesting to see, because Tesla was a relative unknown besides people that are involved in the stock market perhaps. But with that Consumer Reports 99 out of 100 rating and all the press it's gotten, I think you could see a big jump in sales, and I think that's what people are counting on with Tesla at current price levels. Take a look at the chart here. Tesla's held up really well. Yesterday it got back above the $100 area, and this is one that, when you have these really, really highly shorted stocks, I know it's tough to chase it, and I wouldn't buy it and put it in the drawer up here, but it's one that for short-term traders, these can go faster and farther than you can ever imagine, especially when there's such a high short float like you have with Tesla. And now it's above all of its moving averages again, and really looking healthy. I think you could see an assault on these all-time highs at some point. And
how about SolarCity? Closed the day down 1% yesterday.
Yeah, SolarCity, obviously the big thing last week was that IPO lockup expiration, where people who got the shares in the IPO weren't allowed to sell until last week. But there doesn't seem to be a ton of urgency to sell, because most of the correction that we got in SolarCity was prior to that IPO lockup expiration, which tells you it was more a result of fear. The biggest thing you have to fear is fear itself, they say. But the IPO lockup expiration didn't really trigger any more downside in SolarCity, as Brittany laughs at me for that comment. And now I think the fact that we didn't see a bigger follow through to the downside on that IPO lockup expiration, I think it could lead to a squeeze. Over the last several years, we've seen a few examples of stocks that people were really worried going into the IPO lockup expiration, but then there wasn't really a big follow through to the downside, and then afterwards it triggered a big move. So you take a look at the chart of SolarCity. I think it's one that could get on the move again. The solar sector in general has a lot of questions, but those stocks are holding up pretty well. It did get rejected yesterday at its 21-day moving average, but it was on really low volume. So I do think you should be watching SolarCity if you're a short-term trader for sure. And I do think that we could potentially get a squeeze. The longer it doesn't break down after that IPO lockup expiration, the higher the likelihood I think you could get another squeeze that could take it, maybe not back to highs, but you could get some nice percentage moves, up into some shorter-term resistance levels.
I like that. It's a brave trading thesis.
The
only thing to fear is fear itself. Remember that. How about MGM starting to act better after holding its earnings gap on the recent pullback?
MGM's got a nice little pattern. It actually has a nice pattern that's similar to what we saw in Netflix prior to yesterday. I know the stocks have very different profiles. Netflix is a lot more highly shorted. It's in the tech sector and all that type of stuff, but the pattern is similar. So we try not to discriminate based on symbol. We just like to look at patterns and stuff like that, mechanics of a trade. But MGM, a nice descending channel or wedge, whatever you want to call it, a little bit similar to the market, I guess you could say too. But if we do get a break of that downtrend, I think you could get a nice move higher in MGM. That's another one yesterday looked like it wanted to break out, but was weighed down perhaps by broader market weakness.
And just for our gold bugs out there, GLD still looking pretty weak, trading below the 8 and 21 day. Do you think we'll see a pullback into that double bottom level around 130?
Yeah, I mean, gold has been dead quiet leading up to the Fed announcement. I think it's obviously very dependent on central bank activity to drive its price action. And you've seen it sort of just really dry up the volume and the range here. And I think the Fed is headed towards tapering and longer down the road, higher interest rates, and that's a net negative for gold. Some people think that if the Fed does come out with QE tapering and the market goes into some turmoil, maybe you could see a safe haven trade into gold. But the thing about gold is, like I said, it's when central banks are more active, it's a positive for gold. So I think you could see situations more in the future where gold doesn't respond positively to market turmoil and actually sells off with other assets. So I really think that 130 support level will be tested, and I personally think it will break as the Fed starts to exit its unprecedented bond buying program that has driven the price of gold for the last few years. In general, though, I don't tend to touch gold. I think it's so volatile. There's so many factors that go into its price movement that we don't understand, central bank buying and stuff like that. I would generally stay away from it, focus on stocks that have a little bit more rationale in terms of why they move.
Well, clearly we should be prepared for some potential choppy action today. What's your advice to traders as they head into the trading session? Yeah,
I hate to be redundant. I hate to tell you not to do anything, but that's my best advice, I think, right now is sit on your hands a little bit, be a little less active. I don't think big players are going to be taking big bets in either direction right now. So sit on your hands a little bit. If we do get a break above the pattern, maybe you dabble in some longs and you don't ignore the pattern even though it's leading up to a big announcement. But I think everybody's hanging on the Fed right now, hanging on their every word, and you could see some more headlines about what could come from the announcement from journalists and things like that. Those type of headlines will make the market very erratic, so be very careful out there and perhaps wait till the Fed announcement is passed.
And have a great Tuesday. Happy trading.